continue to invest passively as well, because like at the end of the day, you can have some depreciation, right, from your investment, as well as cash flow component, and you have a chance to, let's say, 2.5x your investment. It's hard to say no to that, right?
Hello, and thank you for joining us today on the Gentle Art of Crushing It show, where we focus on learning and sharing with our listeners all there is to know about how to create success in our lives. This show stands on the shoulders of giants. Our mission is to empower and inspire our listeners to create the life of their dreams whilst having a blast in the process. Let's celebrate life together. Welcome to the show.
All right, welcome back to the Gentle Art of Crushing It podcast. My name's Randy Smith, and I'll be your host today. And I'm really excited to have a fellow member of a mastermind that I'm a part of, Paul Khazansky, with us. Paul is a pretty heavy passive investor. He's currently in 16 L position. He's had 8 LP positions go full cycle. And just really excited to have you here, Paul, to talk about all of those things. So welcome to the show.
Happy to be here. Thanks, Randy.
Awesome. Well, why don't we go ahead and dig right in? Paul, can you tell the audience a little bit about yourself and how does someone get to a position where they've got 24 LP positions in real estate related deals?
Sure. So look, I'll quickly cover my 20s. I spent 20s primarily in Wall Street, working in a couple of different positions with credit analysis. So analyzing deals in one capacity or another. Then got my MBA out of the way, and then went into essentially a real estate startup in 2013. And in 2013, our strategy at the time was to buy dilapidated buildings around Baltimore and reposition them through adaptive reuse into essentially Class B apartment units, right? And did a couple of projects. One was 10 units, a couple were 25, one was 60. So that was kind of like me wearing a developer's hat. It was me and a few other partners at the time. And then we fell almost backwards into self-storage space. Like we were presented with a building that would not underwrite as multifamily play or an office, but as self-storage, which was interesting. And that was our first self-storage project. And we've since done a bunch more since then. Did that for probably like another couple of years. And then me and one of the guys, while continuing to be developers, we pivoted and we co-founded a private lending platform called PSG Lending. And essentially there, our typical client was not so much fix and flipper, although we had some of those guys as well, but it was like a smaller developer who would not qualify with a local bank for whatever reason, right? We tried to sort of, make good decisions, giving money to the right folks. And it was a lot of fun growing the company from scratch. And then when I exited the business and the partnership 2 years ago, we had 8 people, staff, and putting out north of 60 million origination per year. So that was 2 years ago. And for the last 2 years, I've been heavily investing in various real estate deals, primarily real estate, as an LP investor, which has been a lot of fun.
Yeah.
So
awesome. Okay. Well, that's a heck of a story. And I believe you mentioned you were with, I think I saw from your LinkedIn site, you were actually with Moody's for a number of years. And that's really how you kicked off your analytics and your analysis background and experience with a very large organization there. Can you talk about that a little bit? Because I hear of the organization, and understanding of course, if you can't, then we can just move on very quickly as well. So
no, there's no NDA on Moody's. I mean, look, it was my first job out of college, right? Yeah. Like I didn't really know much about how to like analyze companies, how to like understand what their credit worthiness hinges on. So that was a good company to just kind of like hone my fundamental credit analysis skills. I thought it was an interesting time. And after that, I spent some time with a few hedge funds where I was able to leverage that background and once again do a lot of kind of like credit decisions around businesses, companies that would come across my desk.
Interesting. And then so that you parlay that into a partnership where you're actually doing full underwriting on potential opportunities that you're going to be lending to. So you have the background and experience to know what do successful businesses look like, what do good assets look like. And that's what allowed you, I mean, ultimately to become a lending partner as well, I suspect then, right?
Yeah. So look, any lender will tell you they underwrite based on the worst case scenario, right? So kind of like, what happens if you give this guy money and you never hear from him again, right? At any point that the money is out. And we would need to be comfortable with that scenario being in the cards. And we would need to feel pretty comfortable that we would get all of our money back. So while I was there, we did north of 150 or 160 loans, and we never lost any money, never lost a dollar in principal. And we had like 5 or 6 positions where we got less than 100% of the interest owed. It was like between 75 and 90% interest. But all in all, it was an exciting time. The lending game became kind of like more difficult as the margins got squeezed more and more. Like as you remember, as the interest rates. So what happened was as the interest rates went down, it actually became more players have entered the market, and we had to compete with guys whose cost of capital was below ours, and that did not make things easier, right? So we had to sort of figure out if we're comfortable taking more risk, or we had to find some other edge to compete. So, for example, we did a lot of ground-up construction projects. Given our background in construction and development, we could underwrite that risk. Versus, a lot of other lenders just don't have that background and they wouldn't touch ground-up projects. So it was an interesting time. Learned a ton about underwriting all kinds of deals, which made it easier for me to become a passive investor. Almost full time for the last 2 years.
Are you interested in real estate investing but don't know where to get started or think you don't have the time or money? Are you stuck in your W-2 because the golden handcuffs make it hard to walk away? If this sounds like you, check out impactequity.net and schedule some time to talk with the founder, Randy Smith. Randy went from massive income to leaving his W-2 through passive income, and he can help you do the same. www.impactequity.net.
So, yeah, very interesting. So you come from a very analytical background. You're used to looking at business models, business plans, underwriting models, and determining whether it can make sense for you and your partner's investment. And then you switch over to the lens of doing that same process, I suspect, for your own personal investment. So what does that due diligence process look like as an LP investor with somebody that has the experience that you have?
Yeah, so that's kind of like a very open-ended question. We can talk about this for a long time.
Sure.
Yeah, I'll tell you one of the things that happened. So in the 8 years that I spent with a former partnership, all the money that all the projects that I've been investing in were pretty much development projects, right? Some were existing buildings and we repositioned them to like a different asset class, and some were ground-up construction. And one thing that I learned is that the cash-on-cash component on a ground-up construction deal is not very sexy, right?
Right.
If you're dealing with self-storage, you got to get all your, you take down the land, you got to get all your permits in place, then permits, zoning, what have you. Then you go vertical, right? I guess you break ground. There's lots of risk. Things go sideways. They take a lot longer than you would expect them to. And then finally, when you build the building, you have to stabilize it. And for 100,000 square foot box, which is what you see with a lot of like extra space or cube smart buildings, it takes 3 years to stabilize the project. So from the beginning to a point that it's stabilized, it easily takes 6 to 7 years. For you to really get your money out through like a liquidation event. So not much of a cash to cash at all, and you have to be very comfortable just hanging out for 6 or 7 years to see any cash coming back to you, right? You might get like a 2.5x return on your initial investment, but you got to be very patient, right? And the last 2 years, I sort of realized that I don't like to not get the cash on cash component on most of my investments. And I've been looking, whether it's multifamily or self-storage or mobile home parks, but situations where there is a cash on cash from the day you come in, right? So, if it's a self-storage deal, it would be an existing building that somebody is doing some sort of a value add work to, so that maybe they're like increasing the density, or they're doing like a small addition, or the improving on the operations of the existing building, right? So that you don't have to wait for 6 or 7 years to see your money back, and you can come in and get 7, 8, 9% cash on cash starting year one, right? So I become a big fan of that model, and basically every single investment that I've made, with an exception of one short-term development play where it's about 18 months from start to finish. It's a townhouse development, and basically the developer was breaking ground as he was raising the capital. But aside from that project, every single other project I'm investing in, regardless of the asset class, all had a strong cash and cash component.
Yeah, there's a lot there we could unpack, but I'm curious more. I think you mentioned that in these development projects, the exit was to something like a CubeSmart or something like that. So they were requiring 3 years of stabilization. My understanding is that there's kind of different phases that you can do in development. It's as you said, the land acquisition piece, which you have the whole entitlement process, which that can take, literally that can take years, that piece in and of itself, depending on that piece. But once you have permits, you've got entitlement completed, you can potentially invest at that point, which is just simply going horizontal and then vertical. And that can take 12 to 18 to 24 months. And then I've also heard where there's opportunities where you can invest once it's gone vertical, but maybe it's not been stabilized, or they've just essentially filled it up with anything they can fill it up with. And then the value add becomes taking that loss to lease or burning off that loss to lease to get it to current market rates. So is there an appetite on your part to look at other phases of that piece to kind of shorten that window? Or is it just simply you want cash flow from day one, and those are the only type of opportunities you look at?
I would say there's a lot of that, right? There's a lot of situations that have a cash and cash component, because at the end of the day, I think we're all trying to create passive income, right? We all try to sort of get to a point where you don't have to, go to work, or I expect to go to work as long as I live, but sure. I'd like to get to a point where I have enough of a cash flow component to cover all my expenses, right? So to get to that, you kind of have to focus on situations that have a cash and cash component pretty early on, whether it's from day one or it's 6 months into the project. And like I said, the only exception that I've made was a townhouse development where it's for sale, right? So the guy starts on whatever, Gen 1. It takes 12 to 14, maybe 16 months to build a townhouse, and then you exit. So by month 16, 17, maybe 18, I expect to have the money back. So I haven't seen a lot of interesting plays where you can come in at a different point of value creation, right? So like if somebody received their certificate of occupancy, could you come in at that point? Maybe, but like how much? I just haven't seen situations where a developer is willing to take on new equity at that point. Usually they can go to the banking community, Lender. Right, and say, look, most of the risk has been removed, right? Can you give me a bigger loan, something like that?
Got it.
So I just haven't seen a lot of interesting plays where you can come in mid project.
That makes sense. Yeah, no doubt. It's and I think it's probably different between self-storage and multifamily, and all the different asset classes as well. Seems like self-storage would be easier to fill. I guess principally though, you could fill something easier if you were to drop rates just to fill it up, so you can get that 90% occupancy.
Randy, and if I may, so So they asked me the question kind of like, how do I underwrite the deal, right? So I've been kind of like, talking a lot about the cash and cash component, but also like the economics of the deal, like how you split the pie, right, between the sponsor and the LP. And I've seen anything from, 80-20, where the LP gets 80% of the upside, developer gets 20, which is obviously very fair, to the other way, right? Where the developer gets 80 and the LP, who has vast majority of the risk, gets 20%. So, things like I'm surprised they're able to raise money, but there were guys like that that are able to raise money. So you got to like pay a lot of attention to the economics. And finally, the track record. You and I were talking offline about a couple of guys like DLP or Post Investment Group. Like, companies been around for a long time, get audited, have a history of doing really, really strong returns for a number of years. So I would say those are the things, like, the cash flow, the economics need to make sense, the tenure or how long any given developer or real estate investor had been around, sponsor, and their track record. Like, those are the things I tend to focus first and foremost.
Okay. Yeah. No, thank you for that. I think it's, after you get beyond kind of the very high level basics of passive investing, understanding metrics and those types of things, there's a progression of the passive investor's journey. And I went through something similar to you. When I first came in, I was in my W-2. I had very good income, so I didn't need cash flow, or I didn't think I needed cash flow. And I would hear people saying, cash flow, cash flow, cash flow, cash flow. And I'm sitting on the sidelines thinking, it's crazy. I technically don't want any more cash flow because I just don't want to deal with the tax consequences and all of that. I'm really kind of saving for a rainy day. But then when the circumstances change and all of a sudden I got laid off from a job, I became a cash flow investor with the snap of a finger. So, what I've learned by hanging out in the community that you and I are a part of is that it's usually a good idea to focus on cash flow until all of your expenses are covered. And at that point, you can handle the risk of going after some more of these other lower cash flowing or no cash flowing investments that are going to ultimately grow that bucket faster. So it's interesting that even from your perspective, you've had a similar experience with that, and you're back to cash flow just like I am today as well. So.
And I would say, look, you can find, as you can find strong deals where you have both the cash and cash component of 7-8% cash and cash, as well as, a 2.5x equity multiple, right? While, over the life of you holding the investment. Why would you even want to touch something that has no cash and cash, has all kinds of risk, might get a capital call, whatnot, on a development deal, right? Where you are probably still going to end up with a very similar multiple, unless it's a 4x multiple with a ground-up construction deal versus a 2.5x multiple where you have cash and cash. But I don't know if I believe in the 4x multiple in the ground construction. I know they exist, but I feel like they're few and far between.
I agree, and you're never going to see that on an investor presentation, and if you do, run, right? Absolutely. So yeah. Well, I'm wondering too if we could shift a little bit here. You mentioned that you had kind of shifted into the space where you were starting to look to potentially be an operator in, I believe it was self-storage or triple net potentially, and you spent almost 2 years looking for things that would meet your underwriting expectations. And it just did not exist. So I'm curious, can you talk through that process and maybe the mindset and some of the challenges you went through that journey as well? Or?
Yeah, sure. So the way to make money in real estate is to add value, right? So you can buy land and go vertical, or you can buy an existing asset that's poorly operated and increase the pricing, or maybe fix the roof, raise the rents that way. Or increase the occupancy level, right? Those are some of the ways that people typically make money. And I spent probably close to 18 months looking for value add deals within the triple net industrial, which has been on fire in the last couple of years, right? And After putting 24 LOIs in the first 6 months of 2023 and getting 0 for 24, I just realized that you either have to, as a broker told me, you got to take it on the chin, right? Have no cash on cash for the first like 2-3 years of investing. And then come year 4 or 5, you can start like raising rents and you can probably get, I don't know, 3, 4, or 5% cash on cash at that point. And I was like, that just sounds like a horrible proposition, right?
No doubt. Yeah.
Yeah. Like, so there's been a major disconnect between the buyers and sellers, right? For the last 12 months. And, instead of, kind of like lowering my expectations and, settling for mediocre investment projects, I just kind of like, I was totally fine investing as an LP in situations where people were able to find usually off-market deals that had better economics, with a cash and cash component, often had a depreciation play, right? That you and I both care about a lot. So, and then basically a few months ago, I sort of made a decision to focus on purchasing an existing business. One, because I realized that if in real estate you buy something and has like, a 9 cap or 8 or 9 cap, that's considered great. And, businesses, it's more like a 30 cap when you buy something. So for real estate guys, it's hard to like wrap your head around that number. But it's a different level of risk, right? There's operation experience is required, or you better be able to operate well. But the upside is tremendous. And as I think basically, we're facing what are they calling the silver tsunami? Like something like 11,000 baby boomers are retiring every single day, right? Walker Diebel talks about it in Buy Then Build. Like over the next 7 years is just a fantastic time to try to find a business that's simple to operate, has a great track record. You can borrow up to 90% from Small Business Administration through SBA 7A, right? And just operate the business versus buying something in real estate for like a 6 cap when the cost of debt is 7, and pray that you're able to improve everything really quickly, and then hopefully you can raise the rent and yada yada yada.
Yeah. Well, and you've got the experience having been a partner in multiple deals or multiple businesses and successfully ramped those up. So I'm curious, you mentioned you've got to have some operational know-how ultimately to get into that space. Is it, and I've not spent really any time looking into business acquisition up to this point, but I'm intrigued with it. And my fear would be that you would have to hire somebody really to run the business unless you wanted to jump into the weeds from day one. And if I didn't have the knowledge or know-how, how could I hire the right person or manage that person? But I think it's a higher level of risk than anything I've been exposed to, but I'm curious your thoughts on that.
Yeah, look, I totally agree with you. It is a higher level of risk, right? Like you buy, a triple net small bay industrial deal, and you have, let's say, 30 bays, and you put in a tenant into every bay, and if they pay, great, and if not, you evict them and you get a different guy, right? And if you have roof leaks, hopefully you have insurance, but you can address it. With the business, there's a lot more moving variables, right? Like what industry is it in? Is the industry getting tailwinds or headwinds? What's the concentration of customers, of suppliers? Are your competitors killing you? Is the guy selling because he's ready to retire or because the business is falling off the cliff? Like there's definitely more risk. I think there's no question about that. I think operations experience is helpful. I don't know if it's required, but it's definitely helpful, right? So like at least you have some idea of kind of like what it is you're walking into. Most guys who I'm aware of, they buy a business and kind of like they go in the trenches and they really learn the business inside out, right? And there's kind of like two schools of thought, you can go in for, let's say, 12 months and really learn the business. And then you can put an operator and slowly phase out, right? So you got to find somebody who's a very talented operator who can be your right-hand man, maybe give them a piece of the upside to incentivize them. And at some point just kind of like cut your time from 50 hours, 40 hours a week to hopefully 5 or 6, and then you just manage the operator. That's kind of like one dream. And then the other dream, which another sort of school of thought, is to buy one business and go all in on it and win a gold medal, right? That's I think it's Jeff Hoffman's. That's his mentality. That's what he argues for.
Okay.
So,
sure.
Yeah, because basically, if you can go all in and you can kind of like really, really push hard to take it to several levels higher, you can take a business from, I don't know, from 5 million in price to 25, 30 million in several years, which would be very hard to do if you bring a guy in and you pay him salary and give him like a piece of the upside.
Yeah, interesting. And I think ultimately you're doing the same thing with real estate anyways, because odds are you're hiring property management, which is your operations team, which would be very similar to this as well. So albeit more risky, very similar type of model when you consider really what you're hiring for when you're buying these assets. Because at the end of the day, whether it's multifamily or self-storage or a B2B business, these are very large businesses that are driving EBITDA. And ultimately, we're buying yield with these, and you've got to have some expertise to make sure that everything's happening there that needs to be happening to make sure that your investment's taken care of. So very interesting. I've not, as I mentioned, I've not looked into that space yet, but this conversation has me thinking maybe I should more and more, but very, very interesting. Now, in regards to your passive investments, you still have a rather large portfolio of passive investments. Are you recycling those returns today? Are you continuing to invest passively? Are you trying to stack capital for, this SBA purchase potentially in the future?
No, so look, I remain very active as a passive investor, right? I would say this year I slowed down somewhat. I think I invested in 3 or 4 deals this year, probably like 5 or 6 deals last year. Once I buy a business, I will probably continue to invest passively as well, because like at the end of the day, if you can have some depreciation right from your investment as well as cash flow component, and you have a chance to, let's say, 2.5x your investment over whatever 5-6 years, like it's hard to say no to that, right? Assuming you can bet
Sure.
on the right jockey. And that's kind of like where you look at the track record, right? Those things we talked about. How many times this guy has done this before? So, yeah, I expect to remain pretty active there. And look, with businesses, kind of like if you do well, if you're successful, right, you will make lots of money. You will have to pay lots of taxes. So investing in real estate and getting the bonus depreciation component will tremendously help you to save money. I think this is not obviously investment or tax advice, but that's right. But that's kind of like that's one of the benefits of investing in real estate is that you can have some serious depreciation benefits that can help you offset your income. If you have a real estate professional status, it can help you offset your active income. And if you don't, it can help you offset your passive income.
Yeah, no, absolutely. I preach all the time. And really the avatar of this in our audience is the high income W-2 employee. And, my advice always is maintain whatever it is that you do to make money, keep that in place. And then leverage real estate for the tax benefits and the equity multiples and cash flow you can generate. And that's really the perfect marriage. So you're doing that one step further, owning businesses to drive very large income, but still leveraging passive income for all the tax benefits. So very, very cool. Now, as you look at the next few years, we're recording this in December. It'll probably get published in January. But as you look to the year ahead, any asset classes, any trends, any economic indices that you're watching closely that'll help you make decisions on where to place capital in the coming year?
Since this is really kind of like about passive investing and kind of like LP positions and buying real estate, buying businesses. Look, I'm also a believer in Bitcoin, which goes through like 4-year cycles. And the last couple of years, it's it took it on the chin, so to speak. And now, kind of like we're kind of like coming out from the crypto winter, like we're now in the spring, and I have lots of enthusiasm for 24 and 25. I think we'll be in the crypto summer. So I am paying more attention to, the Bitcoin and maybe like a few cryptocurrencies to supplement all the other investments that I've made within the real estate investing world.
Okay. All right. We do not go down that path hardly ever. So it's interesting to hear. I have not heard of the Bitcoin winter. I guess I've heard a lot about the Bitcoin winter. I've not heard about the coming spring and summer for it. So that is interesting to me.
And just to kind of like answer your question fully, I'm also investing in kind of like a holdco structure where you have a holding company that's investing in a portfolio of companies, right? So you may have again, like a single holdco level company, and underneath it there is 16 different businesses, right, with respective CEOs and operators and CFOs, and they have like fractional, C-suite guys that sit at the holdco level to help bring efficiencies and just make the businesses better. So that's the first investment that I'm about to make this year that I haven't made before, but that kind of goes to the whole business investing theme that we talked about.
Sure.
Except here you're betting on someone who's done it before, and again, like they have a decade of track record to show that they know what they're doing. But look, once again, you get the cash on cash component, right? And you also participate in appreciation in the value of these businesses, right? These underlying businesses as they grow and they get bigger. In the passive capacity, once again, this kind of investing opportunities is not nearly as common as the real estate deals that you and I see every day, right? It takes a little bit more effort to find these deals than the holdco level deals, but they're also wonderful if you care about investing passively and getting the cash on cash component.
Interesting. So it sounds very similar to like a fund of multiple assets in the real estate space, but it's just multiple businesses. Generally on those funds, they're a longer term hold. Do you see that these are longer term as well, or what's the exit strategy?
Yeah, there's like a 5-year lockup, right? So if you see yourself having need for this capital in the next couple of years, this is probably not the right one. Same as most real estate deals where the money is locked up, right? If it's a development project, construction project, your money is probably locked in for at least 3, 4, 5 years, if not longer. So you have to be comfortable with the illiquidity aspect of it, right? But I'm okay with that.
Yeah, very interesting. I know I hear a lot of people in the community talking about this model that you're suggesting, and again, I've been kind of sitting on the sidelines watching, as I tend to do for a couple of years before I'll generally jump into anything new like that. So very interesting. I'll have to dig into it and learn a little bit more. So very good. Well, yeah, Paul, this has been an interesting conversation. Is there anything that we should have discussed or anything I should have asked that maybe I missed, or anything you'd like to share with the audience before we go to our final set of questions I'd like to ask everyone?
Look, I think it's very important to do your diligence on the companies that you're investing with, because everyone can look great and sound great, like the rising tide lifts all boats, right? That's like what we've been experiencing over the last several years. But as we are kind of like wrapping up 23 and entering 24, there's been lots of guys that are losing shirts with their investments because they invested in the wrong entity or the wrong sponsor. So for people who don't have the experience to size up a sponsor, just be careful to go in blindly, right? Because there's plenty of bad actors, some intentionally, some not intentionally. Like some guys who have very expensive debt today. There could be great people with the best intentions, right? The road to hell is paved with good intentions. But right, the interest rates went up so much that some people got really hurt in the process. So I would just say just be careful to guys that see appeal in this kind of like passive investing with cash component, depreciation component. Just to be careful picking your winners, because some of those guys, not everything is gold that shines.
Yeah. Very, very good advice and fitting for final comments on a passive investing show for sure. Because ultimately, you're betting on the jockey, and a good jockey can make a bad deal good, or a bad jockey can make a good deal bad. So, really good advice to wrap it up here. So, very good. Well, Paul, I do have a few questions that I'd like to ask everybody before we finish up the show. One that I like is geared more towards the newer passive investor. But if you were to offer some a book suggestion or a podcast suggestion for the individual that's just getting started in the space, do you have any suggestions for the audience?
Yeah, so I love Alex Hormozzi's The Game podcast. I think that guy has just a tremendous amount of wisdom. I think Brian Lubin's with his Action Academy has done a wonderful job on his podcast. Books wise, if you're thinking about doing this passive investing journey, I think Charlie Munger's Almanac is a wonderful book. What else can I tell you? I mean, look, there's a gazillion books, right? Some are way better than others. So I would say that, and the Almanac of Naval Ravikant is just a wonderful book about life philosophies that I recommend to all my friends.
Excellent. Well, thank you for that. I just bought Charlie Munger's Almanac, and I'm waiting for that to arrive, hopefully any day now. And then Brian Lubin, of course, he just launched a new book as well, which is awesome. He's got a great podcast. And then Hormozzi, I've not listened to the podcast, but I've bought his most two recent books, which are fantastic. So, very good suggestions. Okay. Excellent. And then kind of a fun one here. You and I are both part of a community that likes to focus on bucket list items. So is there a recent bucket list item that you've checked off the list, or one you're hoping to in the near future?
Oh boy. Recent one. I mean, I went to Japan, which was an awesome trip.
Fantastic.
Yeah, I went with my wife and brother and his woman. Japan has been amazing. I think skiing in Japan is definitely on my bucket list. So
fantastic.
That's something that I definitely want to cross off in the next couple of years.
Very cool. Very cool. Well, Japan is on my list as well, and not checked off yet. So I'll reach back out to you when we finally get that one booked. So,
sounds good.
Very good. All right. And then our final question I like to ask everybody: if you were investing $100,000 today and you couldn't invest in one of your own deals, where would you place that capital?
So I think it comes down to kind of like how much risk tolerance are you comfortable with, right? Like there's companies like Reliant, right? Self-storage, like great company, been around for a while, great track record. Their returns might not be as generous as somebody who is not quite as established, right? But I think it's very unlikely you're going to lose your money. Like I love those guys. I think they're doing a wonderful job. You know, if you want to take on more risk, you will get high return, right? Somebody who hasn't been around for quite as long, somebody who is willing to pay more, right, to kind of like get your money and build their reputation that way. And then kind of like as you go further to the right of the risk spectrum, that's kind of like when you approach, you know, things like the Bitcoin investment, right?
Sure.
Like that's kind of like the upper echelon of volatility, right? It can go up or down, 10%. If you're a believer that it's going to go to the moon, then you invest. But it comes down to kind of like how comfortable are you with placing your money at risk. And if you're not comfortable at all, like I have a friend like that, he's investing in treasuries, right? He's all the way to the left. So I have friends throughout the whole spectrum, and I try to sort of
Sure.
I try to listen who's investing in what and what's the downside in every case and what's the upside. Right. So kind of like, not to talk too much about Bitcoin, but if there is a very small probability that you're going to lose all your money and a relatively high probability that you're going to make 5x your money or 6x your money or 10x your money, like maybe this investment is interesting. Right. And if you have an issue with, let's say 1% of Bitcoin going to zero, you don't touch that bucket. Right. You move to the left and somebody who's done 3 or 4 or 5 deals but they're still relatively green, maybe invest with those guys. And if not, then there is DLP, who's even more safer, right? Which and I know is a company that you are familiar with. So it comes down to personal choices and your risk tolerance.
Love it. Really good advice, Paul. So, yeah, thank you so much. This has been a fun conversation. You never really know where they're going to go when we start these, but this one brought us down a couple of different rabbit holes that I think brought a lot of value to the audience. So thank you so much, Paul, for being on the show. I appreciate it.
It's been a pleasure. Thanks, Randy.
Awesome. All right. And to the audience, as always, thank you for joining with us again today. Be sure to come back next Thursday. We'll have another great guest on the show, and continue your education process in this journey of passive investing. I'm convinced that once you make the decision to start passive investing, you'll be so glad that you did, and just wish you had started sooner. So be sure to like and subscribe to the podcast. And thank you again for joining us today.
Well, there you have it, ladies and gentlemen. Another episode of The Gentle Art of Crushing It. It was an amazing episode. We know we sure learned a lot, and we hope you did as well. We want to take a second and thank you so much for viewing or listening to this episode. And please just know that we only ask for one favor, and that is to make this life magnificent. Thank you, and have a wonderful day.